Thank you, Amy. So yeah, in this session, we're going to look at the future of onboarding, and we're going to look at as the sort of profusion of data increases and customer expectations change, we're going to think about what does that mean in terms of delivering smarter decisions to your customers and smoother journeys within the onboarding process. So by way of introduction, I'm Martin Smith. I head up pre-sales consulting at Equifax. I've got a sort of long and checkered history in the credit industry. I've worked at all three CRAs. I've worked at one of the kind of consulting firms for about 12 years, but I started my career in decisioning at First Direct Bank, part of HSBC. So that's me, Mags.
Yeah, hi, I'm Carl Magnus Wodsack. People know me as Mags. Nice to see lots of familiar faces. Thank you for coming today. If you see a 1,000-yard stare from me, I'm still recovering from Glastonbury. Apologise for that. Like Martin, I have an equally checkered history, although I've only ticked off 2 of the bureaus, so I am available for hire. I work in the same team as Martin. My focus is around product-focused sales specialism to support our strategic clients, and my focus really is on like smart data and open finance solutions. So hopefully you'll see how that feeds into this conversation as we move forward. So why are we here? Why are we here, Martin? Digital first lending. I think everybody expects in this world that they can just apply for and gain credit with minimum interaction. People are used to having their smart devices. They want instant gratification. And whilst that's been the normal process, certainly accelerated via COVID for someone to be able to apply for and be accepted for something like a credit card or an unsecured personal loan, which due to the value has relatively low risk, customers now looking to be able to also apply for things like motor finance now and mortgages, secured lending without any interaction. And obviously, the current journeys and current decisioning, whilst they're set up to support, underwriting of low-risk credit, in order for you to do, complete underwriting and straight-through approval and acceptance of high-value products, you're going to have to bring in additional data sources and orchestrate them into a journey in a different way so that the customers themselves have the best possible experience and get what they want as quickly as possible, but also as a lender, you don't find yourself with a blind spot regarding fraud or credit risk as a result of the reduced interaction with your customers. This is borne out on the next slide. I won't go through all the stats on here, but obviously, as I mentioned, instant gratification. There's a stat on there, for example, that says in the last 5 years, customers who are using digital-only banks as their primary bank have increased 9-fold. And the number that stands out to me there in particular is that 33% on this survey of individuals would be happy to make a major purchase like a mortgage without any human interaction at all. And that's only increasing. So how are we going to get that done, Martin? I mean, obviously there's the expectation, the changing expectations. We're going to have to change the way that we orchestrate the data, the decision process, bring all that together. And what we can't have is a situation where when you bring in that new data source, it just looks like a bolted-on afterthought and creates a really, really clunky customer experience. So what we're looking at is ways of orchestrating that to create smooth customer-first journeys that use the data from the very beginning and to give the best outcomes.
Cool. So I think the kind of interesting thing about those stats that you shared, Max, is that to me they felt quite low. I think if you're kind of part of Generation Monzo, as I am, you sort of have this expectation.
There are other banks available.
Other banks are available.
Yeah.
You do have this kind of expectation that things will be digitized and things will move really quickly. So I think in that context, it's worth considering to what extent do our decision platforms actually support the future requirements that we have for decisioning in the future. And so if you're thinking of buying a decision engine, there's kind of a bunch of things on screen here, which are the kind of the considerations that you would have, or the objectives you would have in that decision platform. And really what you've always wanted is for data-led decisions to sit fairly closely to the users that are kind of making those decisions. So you want your scorecard analysts and you want your sort of decision rule people to be able to deploy those rules easily and quickly and accurately. And I kind of wonder to what extent, as I go around the industry, sometimes I come across platforms which kind of haven't really sort of met this brief very well. In fact, what they've done is move the bottlenecks of IT development, so taking hard-coded rules out of IT and plunked those in the kind of business areas. And I wonder if that's true for many people in this room. So here's a bunch of considerations that I would I would recommend, if you're thinking of sort of trying to get your decisioning capability fit for purpose, again, this doesn't mean throwing everything out. This could just mean bolting in additional capabilities. So the first consideration is, do you need to host your own platform? Or do you go for a kind of cloud-based decisioning platform, so decisioning as a service? I think these two things come with different sort of pros and cons. If you're hosting your own platform, it will cost you a lot of money to acquire, and it will take you several months to do it. If you go down a decisioning as a service type route, it will be quicker. And in our own case, we typically get clients up and running within about 4 or 5 weeks. However, there may be some more limitations in terms of the data availability and other things you might want to add in at a later stage. The second consideration is around the decision complexity. So if you're the kind of organization that just wants to make fairly simple decisions, so a score cutoff or a set of rules based on simple characteristics, then probably you don't need the bells and whistles that a very expensive decision platform would give you. Equally, if you're the kind of organization that's heading off in a kind of AI direction, you need the complexity and you need the sort of ability to deploy more complicated things. That brings us on to the third thing, which is around kind of the use of kind of visual tools to build your decision profile. So having a sort of capability to drag and drop components on a screen and thread together a decision process in a really logical way, that makes a lot of sense in terms of making sure your business understands the process. But actually, the devil is in the detail on a decisioning process. And usually, the quickest way to get to the right decision, an accurate decision, is to have a kind of scripting capability that sits beneath it. And typically, the sort of best systems will kind of balance the two, or at least enable you to make sure you have that kind of level of complexity that's delivered through scripts in languages like Python. And fourthly, what I've described is a kind of full toolkit. So comprehensive access to all the data you need to make those decisions. That will vary for every client. In our own case, our decisioning is usually based around kind of bureau data, commercial data, open banking, and client's own sort of application data. But whatever that sort of access to additional data is, your platform should support it, either directly or through APIs. So that's kind of some areas that you need to think about in terms of your decisioning capability. But I think it's true also to say that application journeys are changing, and they're changing in two ways. So the first of them is in the kind of data provision that you would use in making a credit application decision. So if you think about a traditional waterfall type approach, we typically start with a credit assessment using a bureau score and some characteristics, and then we'd move on to an affordability check, which maybe traditionally would use current account turnover data. And each of these stages in the waterfall introduces its own kind of friction points. So it might be that people drop out of the credit assessment or the affordability check, and you have to go off and do some manual underwriting. So increasingly what we're doing is adding more data into this. Again, this isn't sort of headline news. But if you think about sort of the credit assessment process, increasingly people are putting open banking data up front in that process as well, so that you can hoover up those kind of thin file clients who might not be very well represented on the bureau. That same data is available, is really useful within the affordability check. So the idea is that by adding in open banking data into the affordability check, you've not just got Cato data to look at, but you've also got the transactional history for that consumer. Add into that, we've also now got payroll data, HMRC data, and we can really do a kind of decent job in closing those gaps that would otherwise slow down the process. And on it goes across the process, digitizing each of these areas. So what does that allow you to do? Introducing more data so you can reduce friction, you can streamline those manual touch points that would otherwise have sat with underwriters. You can increase the speed of the journey, reducing those kind of more judgmental bottlenecks, and you can remove uncertainty from the process. So that's kind of a data sort of journey. But I think there's something else going on with decisions as well, and that is that they're becoming a lot less linear. So there are usually multiple entry points into a decision platform, whether that's from a broker, from a marketplace, directly from a lender's website or app. There's also a need to sort of run these processes in different ways, and all of them are using the same sort of underlying set of data. So there's a kind of need almost to sort of, I guess, especially if you think about a broker journey, there's a kind of need almost to sort of tokenize access to some of that data. And in our case, we have a process with open banking where that tokenization journey can enable a broker to make the open banking call, but the data to be used by the lender downstream. And that's very much how these application processes are starting to move.
Okay, so here's one we prepared earlier, an orchestration example of how data can be brought to the beginning of a journey to streamline the customer experience and decisioning. There is a name of a product there, but essentially what we're talking about is bringing open banking data to the beginning of the application process. And I appreciate the majority of lenders who've tried open banking have kind of seen it as an affordability or income check that they've bolted onto the end of the journey. And what I want to show you here is how, if you bring open banking journey to the front of the journey, it can really streamline and deliver much better outcomes for the customer. So hopefully that video there on the right will start cycling through, I don't know, but what we've got here is a situation where an individual effectively, rather than being asked to fill out an application form at all, is just asked to verify their identity via open banking. What you get back from open banking is a sort code and account number. That can then be reverse indexed into the bureau, and we can pull back the name, address, and date of birth for that individual. And then we present that back to the customer and say, can you verify this is you? And if they accept that that information is correct, what you've already got there is a verified address, date of birth. You've got the right details. You know we found them on the bureau. You know we found the right information. And right off that, you've got the AML and ID check you can do straight away. You can go straight into a credit check off the back of that because you've got all the information you need to pull that straight through processing. And because you've gone through the open banking journey as well, you've got that real-time cash flow transactional information to augment the decision at the beginning. That is of benefit, as we'll see later, because obviously one of the main friction points from an automated process is where you've got thin files, so where you use traditional bureau data, but there's no extensive history for that individual of how they've repaid products, and therefore you can't predict the confidence of them repaying their loan or it impacting other loans they might already have. The open banking data can fill in that gap, as we'll talk about later. But even better, I mean, we've done a credit check there. Affordability is obviously a key part of consumer duty. We can take the transaction data from open banking, we can pull in bureau database, the name, address, date of birth information, and assuming the customer's connected all their primary accounts, and we can use the bureau to verify that there are no accounts missing. You can orchestrate the transaction data, bureau data, and industry statistical data sources such as ONS and minimum income standards data to create a robust view of someone's disposable income and their affordability. And as a result, you've got all the decision points you need to make just from someone connecting open banking at the point where they start their application journey to be able to do the full application process and be accepted with less chance of them getting refused because of a marginal decline or thin file.
Okay, so where is decisioning going next? And to be frank, it wouldn't be a Credit Week discussion if someone wasn't on stage banging on about AI. So that's what I'm going to do. So this chart shows a kind of a sort of survey from the Bank of England that they undertook in 2024, when they were kind of asking lenders of all shapes and sizes where they expected to be using AI over the course of the next 3 years from that point. And it's true to say that there are very few sort of processes within banking that aren't going to be touched by AI, according to this survey. A number of them are kind of listed on the chart there. And of the ones that are kind of most relevant to decisioning, 60% of respondents expected AI to be being used in fraud detection. An exceptionally good use case because it was pattern identification capabilities. 30% of respondents thought it would be used in more in creditworthiness decisions, so scoring and policy rules. And 26% foresaw its use in credit underwriting decisions, so that kind of more manual process. So where does this take us? So increasing use of AI, I think, is a kind of real feature, and we have to find ways of safely embedding different forms of AI into our capability, into our decision platforms. One of our customers, one of our clients, is using generative AI to summarize 30, 40-page house valuation reports. So they're looking for simple or more complicated sentiments within the file that indicate a problem with the property. So they're using that to condense the report down to a simple sort of paragraph or two that underwriters can quickly assess. If there's no problems, they move through more quickly. Second thing I think we'll see is much more granular data being used sort of directly within the decisioning process, especially as kind of decisions and bureaus move in more of a cloud direction. So the ability to stream transaction data directly into your decisioning capability becomes much more easy to do. And thirdly, again on the AI point, we're seeing sort of increased use of advanced behavioural models. Now at Equifax, we're on this journey of sort of adopting AI in all of our bureau models as one of the options one of the options for future development, as well as having more traditional approaches. But clients are increasingly going down this route as well, where they will use advanced techniques such as neural networks. The deployment of which are kind of quite challenging if you've got a decision platform which is mainly sort of one which is using kind of wizards and so on to deploy a scorecard. So the code for those models tends to be mathematically complex and lengthy and difficult to understand if you just stare at it. Nevertheless, that's a good route to much more performant modelling.